12/11/2013. Time 7:35 a.m. Pacific Standard Time. What we're taking a look is how the bull rally has led us into the last calendar month. And not only that, folks, it's the best month of the year generally for stocks. However, what we're monitoring carefully across the board is stocks that hit their highs. They sell down in the first hourly tape. They come up to the lower high and then they have a reversal, and we're going to take a look at where this trend changes mathematically. This is on Baidu. LinkedIn. Stock was overbought. It's a short gap. They ran this stock from $208 several different times. It comes back up in the price channel and it hits its highs. So this is calendar December. This is what the hourly tape looks like, and we're going to see as we move through this calendar year going into 2014 is where we end up seeing that there is 3 sellers to 1 buyer, a 3-to-1 ratio. Yelp, another internet stock. What we're looking for across the board, once again, is the short side of the tape. This is a algorithm, high frequency, that shot this thing right up to the lower high, but then we have a complete reversal. So what does that mean? That the buyer is not stepping in the first hour, making a series of higher highs. However, normal volatility or historical volatility starts to play its role going into calendar 2014. Here we are in the first hourly tape. As soon as Google hits its highs, there's the gap, there's the sell, here's the bottom up. But once again, it's where these high beta stocks in the Nasdaq 100 have made their calendar 2013 all-time highs. And what we're looking for in December as we close out the year is where the historical volatility turns both for the bull and the bear. So what does it mean? You get a bull gap, and then the bear comes in, it sells down, and we're going to see how they act going across the board. Because what's going to happen as we go through the calendar in year is it's going to tell us what the clues are for 2014. Once again, Bellwether Google, 7:39 a.m. Pacific Standard Time, with a sell gap, and we're going to monitor the mathematical spread between the seller and the buyer. Netflix had an upgrade by Citigroup. Netflix got up to 369. It's one of the better acting ones because of that upgrade. But what we're looking for after it gapped up is called a runaway parabolic up move. We made that high. What the key is now is how that lower high reversal comes in, and how even this bellwether with the upgrade in Netflix would sell down throughout this calendar day and break this low where that gap was. When resorts, casino stocks have been on fire. In 2013, we just made another 52-week high here. We are pulling back once again in certain sectors. We're monitoring carefully where you have more sellers than buyers. So here's that parabolic move up to resistance, and here's that reversal. We're going to be looking at the 185 puts on Win for January. And why would they work for us? And why would we make money? It's because the stock is overbought and we're finally getting sellers instead of buyers. And that this bull run in this name right here is time to get net short, looking at the 185 call. Remember, it's 12/11/2013, 7:41 a.m. Pacific Standard Time. Tesla Motors. Once again, there's a lot of controversy around Tesla Motors. It was one of the best performing stocks in calendar 2013. The stock was extremely overbought when it was up at $190 price target. One of the things that we'll be looking forward to is how the bottom end of this stock would consolidate between now and year end, and where is the distribution. Just remember, folks, that it's already fallen off the highs. We hit 119 a couple of weeks ago, so we actually have a very good lower end of the range, and we can see that that bull is in Tesla. But guess what? Tesla's going to have a hard time in calendar 2014. And why do I need to own high volatility when I can go buy General Motors and Ford or Chrysler, and that this high beta cap is going to once again not perform like it did in 2014, because it's not. But once again, we have a distribution on the opening bell. This is the bottom up in the consolidation. Time is 7:42 a.m., 12:11. Amazon.com. What are we looking at? We're looking at a very choppy chart. Basically, you have these big 3-minute bars right up here to the top end of the resistance in the MMT platform. Then you have the volatility coming down to the bottom. Then you have that bottom up, and this is the opening bell cycle here today. And what we're looking for is where we have the lower high reversal. So, therefore, with this great performer, the way that they run the company, no one is saying that these are bears, but what we are saying is that the current price channel is in an exuberant overbought territory, and as we move through this Christmas season, that this particular name is overbought, and we're monitoring the buyers and the sellers. This is what this opening bell looks like at 7:44 a.m. Pacific Standard Time, date 2011. Once again, it's how I make money on the long side, but we're going to monitor where the tops are and why are we selling down, and where that volatility, both for the bull side and the bear side, and what the net mathematical equation is going to be for Amazon.com. S&P 500 on that opening bell. Remember that the S&P 500 has had an extreme bull for calendar 2013. We were up here, and this is a 3-minute chart, and we will be updating our network, our prop trader group, is why are we finally seeing the bear side of the tape? And that the bull side of the tape has played its course up until 12/11 of 2013 at 7:45 a.m. and net across the board. Why is it time to take profits rather than buy? And let us not forget that the S&P 500, the 500 stocks in this index, have had double-digit gains. That means 400 out of 500 stocks in the S&P during 2013 has had double-digit gains. And how is this index in the S&P 500 going to play out in 2014? And what we're looking for is that historically December is one of the best months of the year. However, Santa Claus is come and gone. Once again, we'll be updating the network. We have called the upper end of this price resistance, and that means that we are not going to close above 1800 again for the remaining calendar month of December. And basically the S&P is only down to 1792, and it's down 9.69 handles right out of the gate. However, the put to call ratio is very imbalanced in the month of December, and that the trade management on the S&P 500 is forward looking going into calendar 2014. VIX, Volatility Index, and what are we seeing? Just the opposite. We're seeing how this particular fear indicator is breaking out higher on 12/11 in the first hour and a half at 7:47 a.m. Pacific Standard Time, 12/11 of 213. We will be updating this fear indicator, but just remember, when this is breaking higher, that big money needs to be buying what we call the calls on the VIX. And that it's a gauge as to where the bear and the bull is. Once again, on the opening bell, we're finally seeing a breakout, making higher highs which means that this is where the fear starts. And does this fear carry over into 2014? Just remember, the indexes themselves have already had the greatest bull run. Now, what we're looking at is where we start to return to historical norms, both on the bull and the bear side of the tape. Once again, when this is breaking higher, stocks go lower. Nasdaq component. And what are we looking for? We're looking how the Nasdaq is selling down and making lower lows. Today's date, once again, 2013, 12/11, 2013. And remember one thing, we're looking for the sellers are outpacing the buyers, and that we're closing out the year, or in the process of closing out the year, let's say. But who's in charge, the buyer or the seller? Remember that these markets have had a great run in 2013, and that volatility across the board will return. That means that the bull goes up and the bear gets in control. So both parties are going to return to normal ranges, and that the actual price volatility will return to historical norms. So what we're finally seeing here is a sell across the board. And we're watching how people are taking that distribution. Remember that the Nasdaq component's at 4,037, down 23 handles. It's had one of the best bull calendar yearly rallies than we have seen in a very, very long time, unless you went back to 1998, 1999. And not only that, folks, we've had a 5-year expansion in this run. And what 2014 is going to bring for both the bull and the bear. Right now, we're seeing where the bear is running ahead of the bull based on this sell down, and how this continuation pattern will continue into next year. Good morning, 12/11. The tape has been open for 1 hour and 20 minutes. We have before us a 3-minute chart on the Nasdaq 100. That's the best performing stocks 100 in this index, which has also been one of the greatest leaders that this index has seen in a long time. However, we are closing out 2013. What we're looking for across the board is who's in charge of the market. And why is it that Santa Claus has come and gone? And to verify that, we need to have 3 sellers to 1 buyer. We're at the double bottom opening. This is just the beginning. And we're historical norms. What do I mean by that? Historical volatility for both the upside for the bull and the bear side as well. Meaning that, does 2014 bring the same gains? No. Dow Jones Industrial Average, one of the best moves above that 16,000 mark right here. We're closing out 2013 on this index, and we're going to tell you now why you're in the month of December on the 11th day, before the fact, not after the fact. What we are telling all of our traders, all of our network, is that 2014 will not repeat itself like 2013. So you're not going to outperform nearly the percent gain levels in 2014, and you're going to return to normal historical volatility levels, that at times the bull will do good. However, the bear is also going to do good, and that the put to call ratios are imbalanced, horribly imbalanced. And that, how do people get sucked into markets at the high? Not only that, there is a lot of money on the sideline that could make its way back into the market. However, the bigger part of the move in calendar 2013 has been phenomenal for the bull. We do not see that continuing in 2014. Rather, what we see is more of a bull tape and a bear tape combined. So instead of being historical levels, means one thing: you're not going to have a one-sided market. And that if you're a trader or an investor, you better know when to sell. And you just better know that the exuberance that happened in calendar 2013 as we end down this year is not going to repeat itself in next year. And who's going to be in control in calendar 2014? Well, we're going to tell you who's going to be in control. Both parties will have control. And both sides of the market, both the bull and the bear, will have equal control in 2014. We have very high margin debt right now in these markets, meaning that the margin debt's higher. The short interest is at historical lows, very low, meaning that the short side and the long side we had for the last 12 years going into this year is that we had a lot of short interest. And what do I mean by that? They have to buy back to go higher. So that means that next year that there is very little short interest in the Dow 30 components. And we'll tell you now, before the fact, on 12/11 of 2013, of what 2014 looks like. And the way that we're telling you is that you're going to have volatility in 2014. And it's not a one-way ticket. We had a phenomenal bull run. Do not look for the same returns, percent level returns in the Dow 30, because you're not getting it. Both sides of the tape will have a breakout for the bull and a reversal for the bear. And what we're seeing today is how the bear is in control and why stocks are at their lows. And remember, we've only been open for an hour and 25 minutes. However, the Dow is down 61 points right now. And that we can clearly see that the bull has lost its steam. And the low at this point is 15,892 on the low end right here of the Dow. And that we started out up here, but guess what? They're taking profits like they should. So, historical volatility for both sides of the market will return to normal activities in 2014. Bellwether, Celgene, Biotech, we did a special on it a couple of days ago. One of the things that we're very pleased with is that Biotech will continue to outperform in 2014. And what we're saying by that is stocks like Celgene, stocks like Biogen, stocks like Amgen, stocks like REGN, and there's a few others, but that we have just had a wonderful breakout from 2011 and 2013, and that we feel that pullbacks in these areas are going to continue to outperform some of the high beta internet stocks that did exceptionally well in 2013. But why is it that the biotech will remain a substantial leader in calendar 2014? Yes, every market has its ups and downs and the way that the FDA works. However, we're in a lot later stages. And remember one thing, whether it's big cap pharma or big cap biotech and a lot of small biotech companies, there's going to be record level M&A activity in this particular sector moving through 2014. Yes, stay tuned for the special updates as we will go through a very in-depth report on the leaders, first tier, second tier, and third tier, and why is it that this is going to be a place to be. Remember, volatility is volatility. So the volatility in biotech is that, yes, you will have volatility, but you want to buy these dips. This is one of the best ones out here right now, and it's underperformed. What are we saying? Is that this could trade easily up to $250 a share. And that we have only tipped the iceberg. They have a lot of stuff in the pipeline. Now, just let me be very clear. There is the ETF that's a way to play it. And we did a special update on what that looked like so that moving forward, we will have great opportunities in these names. This Celgene happens to be one of the next best leaders in that whole index. So once again, we have told all of our bigger traders is that there is a time to buy calls up and out of the money going into calendar 2014. You can go out a whole year, you can go out 6 months, 3 months, whatever the case is. But how do I go out further, invest in Celgene, and then on an intraday level, I can trade around the core holding? Stay tuned. Trade here. Here we are at another time frame, and basically what we're looking at is where the broader markets have sold down. And the time is 9 o'clock p.m., or a.m. rather. It's 12 o'clock p.m., a little after 12 in New York. And Pacific Standard Time is 9:11 a.m., 12:11:13. What we are showing is that the easy money's been made, and that stocks that are overbought, once again, that we have called the top. Once again, just like we had given the short on that S&P 500, which we have at the $1,800 strike, is that the markets have ran too fast going into December. And unlike a year ago at this time, we were just beginning this big bull run where we ended up here in December. And that, historically speaking, that December is one of the better times to be involved in markets. But the problem is, once again, is that markets are overbought. And it's time for a sizable pullback. So, once again, St. Nick, it's Christmas time, but St. Nick, Santa Claus, has come and gone. So therefore, stocks are not on sale. In fact, the valuations across the board in the Nasdaq 100 and the S&P are overbought and will come down. Unlike, just like any other time in this calendar year, whether it was in May or rather it was in August and part of September, is where we had called where these tops were overbought, but each market or each index was met as a buying opportunity. We don't see the buying opportunity at these levels, but rather much lower levels. So once again, we're going to conclude at 9:13 a.m. across the board, and that the Dow Industrial Averages, all of the indexes, and that Dow Transports is minus 82 right now. Okay, so there's some profit taken there, and the Nasdaq Composite has a 34-point reversal. And one of the things that we look at is where this overbought Russell 2000 is, right along with the S&P. And once again, 2013 was a great run for the bulls, but we see a much different picture in 2014.